what I mean by that is think about this comes into the financial services arena, but think about going into a department store, and the sales clerk has the ability. You ask him to show you a good pair of jeans, and they show there's USA jeans that are $40, and then there's some Italian jeans that are $200. Well, they have every incentive to sell you or to push on you that $200 pair of jeans because they make more money. And even though the American jeans do the same thing, they're making more money to sell you those higher end jeans, even though they both solve the same purpose of they both go one leg at a time, they both have the same buttons, they both do the same function, except they're going to try to sell you the higher one that costs more because they make more money. It's natural. And unfortunately, try not to act too surprised when this exact form of salesmanship occurs at large brokerages when brokers sell these high commission products to their customers. And so this study that I'm going to have Matt and Keith elaborate on a little bit, according to a recent White House report, those Americans who receive conflicted advice from the wrong advisor, similar to the jeans purchase above, earn approximately 1% lower each year. Although this may sound like a small amount, it's a huge percentage over a lifetime of earning these investments. So Matt, what does that mean? For the listeners out there that probably don't want to pay extra fees that they don't have to, what does that mean? What's the difference between suitability and working with a fiduciary, which are the two models?
And Derek, that's exactly what I was going to say. So I'm sure our listeners are asking, what does this White House report mean to me? Well, you have to ask in turn, what advice are you getting? Are you getting sort of the SEC only suitability standard advice, or are you getting fiduciary advice? And to kind of give you an idea, or the report itself, here are some of the potential consequences of only getting suitability. So for example, on mutual funds, they have front end, they have loads. They have a front end load and a back end load. And it basically charges you money when you come into a mutual fund or out of a mutual fund. And so it creates a financial incentive to steer investors into funds with higher loads that pass on a larger portion of the load to the advisor. So, as you mentioned, there's a mutual fund that a broker gets paid maybe 4% more. There's
human nature.
Yeah, exactly. It's human nature. I mean, it's just there's suspicion and there's skepticism all over the place as to, okay, what type of advice am I getting? Because that advisor, that broker, has every right to sell you that particular mutual fund, and most importantly, they do not need to disclose any conflicts of interest. It's not required to tell you that that this load or that this mutual fund is costing you this or that mutual fund is costing you that.
And they can do that because it's suitable, right, Matt?
Exactly, just because of suitability. And then on the other hand, for people that are getting the fiduciary, they have to put the client's interests first. Every single investment, every single recommendation has to meet the standard of your interest first. So all of our listeners out there, if you are getting the fiduciary standard, you know for sure by law that you're getting your best interest first, not the suitability standard, which is a step down and does not have nearly the amount of I can't say ethical, but doesn't have nearly the amount of strength and just righteousness that you need when you're getting from an advisor.
Well, think about this, and I'll let you go, Keith, I'm sorry, but think about this from a listener. If you're aligning with someone who is making commissions every time they make a trade for you, or as part of our investment plan, we don't make commissionable trades. So whether we sell you X, Y, or Z in that portfolio under our investment umbrella, it doesn't matter to us. There's no financial gain because we're fee-based. And I always tell folks, even if you're working with someone who they could be doing the best thing for you, but isn't that a weird feeling, knowing that your advisor is being paid more the more he trades? And I feel like that'd be a weird relationship to have with your advisor, because it'd always be that question: are those big trades being made on my behalf so that I can make money, or is he making them so that he can make an extra commission?
Well, and yeah, just to kind of build on that, I mean, I love telling people about that fact that there's not a whiff of sort of like the suspicion. I mean, when being fee-based and when we make these recommendations to our clients and having their goals perfectly aligned with our goals, basically, is the idea that they know that no matter what the recommendation is, it has to be in their best interest because our fee is based on it. So if it does well, great, we get a raise. And if it does poorly, oh well, we get a pay cut. but there's not even the thought or even the whiff of knowing that there's some type of commissions getting paid by the mutual fund companies.
Well, it's funny because, excuse me, when I sit down with folks, I'm usually explaining a lot about, most people don't know that there's two different standards. They think there's one standard in our industry. But no, that we always like to take a step back and say, look, unfortunately, there's two different standards in this industry. You know, which one does your advisor adhere to, or who are you currently working with? There's that suitability standard that Matt was talking about where, to go back to Derek's jean example, obviously, you know, as a salesperson, you want to sell that person the $200 pair of jeans because the company makes more money, you make more money as a salesperson. You don't want to sell somebody the $40 pair of jeans, you know what I mean? You don't, it's just human nature. And unfortunately, that's the suitability standard that many people don't know that even exists. And then there's what Matt referred to as the fiduciary standard, which is, you know, kind of the pinnacle in our industry when it comes to standards. Again, it's putting the right foot forward. It's doing what's in the best interest of the client. It's not having or having you know, people that come on as investors questioning why we're doing what we're doing because they know we're not making any additional money to do it. So, and that also goes in the insurance world as well. You know what I mean? Is if you're, a lot of people that have been coming to me lately and sitting down with me lately said maybe they've met with some other quote-unquote advisors in this area and they want to put all their eggs into an annuity, or they want to stuff them into an annuity. And that's, again, follows that suitability standard, and that's all your eggs in one basket. You can't do that. It would never even pass suitability, or it shouldn't. So to me, it's who you working with. You know what I mean? Like, you want to make sure you're asking the right questions. You want to make sure that the firm that you're working with is holistic.
Sure.
Are they covering your tax issues? Are they covering your legal issues? Are they making sure that your income is going to sustain you? Are your investments in alignment? And the final piece, do they cover healthcare? And if you're not with that firm or you're not sitting down with those people, you should really start to ask those questions and say to yourself, why not?
Exactly, and that's what we're trying to educate folks, because a lot of people don't know that. So we're trying to educate you that there is a choice out there to make, and you can align yourselves with a proper advisor. Over the past few months, the SEC has finally made steps to close that loophole by requiring brokers and advisors to uphold to a fiduciary duty. This move would require brokers to put their clients' interests above their own, which is ironically what they should be doing anyways.
So true.
However, this article says, don't expect the big Wall Street firms to stop a business practice that is incredibly profitable without a fight. They're already lobbying heavily in D.C. to prevent any form of legislation passing that would require them to adhere to a fiduciary standard.
Yeah, imagine you had to tell everyone how much you made.
Bottom line is, you have that option. You can align yourself with someone that literally has to, by law, work on behalf of your best interests and build a plan according to your best interests.